Let's discuss certain special situations when we're AS29. Let's consider the first one. Enterprise is jointly and severally liable. What to do in this kind of a situation? We realize that there is some obligation, but this obligation you are responsible jointly and severally. What to do in this situation? For that portion of obligation for which you are directly responsible or directly obliged, you should recognize a provision. And for that portion for which others are liable, you should recognize that as a contingent liability. So when you are jointly and severally liable, what is the portion of the obligation for which you are responsible? Recognize provision. The portion for which others are responsible, classify that as a contingent liability. We know provision will be recorded in books and contingent liability will be disclosed in our notes. So that is how the AS29 provision and contingent liability requirements will be applied. For example, let us say there is some industrial cluster. Let's say there's an industrial cluster. Let's assume for a moment that there are some 10 units over here and there is a nearby flowing river, let's say. So what these companies, or rather what these industrial units are doing is, let us say they are into manufacturing some product, and during that manufacturing process there is some wastage, and what these 10 units do is they simply throw this wastage in the nearby flowing river, and thereby of course they are polluting that particular river. Let us say right now there is no such law which is disallowing this kind of a practice. Let's assume for a moment that there is no such environmental law, and because there is no such environmental law, that is the reason we are, or rather these industrial units are polluting the nearby river. Let us assume for a moment that an environmental law is enacted, and because of the environmental law, now you are supposed to clean up this particular river. So cleaning up of this river is now necessary. Let us assume for a moment that the cost of cleaning up the river, let us say, will turn out to be 10 lakhs of rupees. Now these industrial units decide that okay, let us divide this 10 lakhs of rupees amongst us, contribute to a particular fund, and then clean up this particular river. The environmental law is very clear. The law is very clear that if you will not clean up this river in so and so time, we will come and seal your industrial units. We don't want such an eventuality, because if the units are sealed, your production obviously will get affected. So that is the reason the 10 units have decided that fine, let us contribute towards the cleaning up of the river, and let us clean up the river and satisfy the requirements of this new law. Fine. As you can see here, 10 lakhs are going to be shared. So 10 lakhs I divide by 10 units. That means the share of every unit will be a lakh of rupees. That's what we mean over here. Jointly and severally liable. Every industrial unit will consider a provision for 1 lakh of rupees. This is the part of the obligation that you have to meet directly. So for that, recognize a provision. So I recognize a provision over here. And what about the remaining? Remaining 9 lakhs. Please understand, not just 1 lakh. Okay, remaining 9 lakhs. You will contribute 1 lakh, while remaining 9 lakhs will be contributed by the other units. Whatever is going to be contributed by other units, disclose that as a contingent liability. This is what all the 10 units will do. All 10 units will show a provision of 1 lakh, and all the 10 units will be showing 9 lakhs as a contingent liability. So the requirement of AS29 is simple. Whatever is the portion of the obligation for which you are liable, please consider a provision, and for whatever portion others are liable, please consider that as a contingent liability. Provision, but what will be the difference? Provision will be recognized in my books. I will debit my P&L by 1 lakh. I will not debit my P&L by another 9 lakhs. Another 9 lakhs I will simply disclose as a contingent liability. Because by chance if those other units do not make the payment, then we will have to make the payment and clean up the river. Maybe 1 or 2 units are of the view that we will not contribute Now their units may be sealed, right? And they may, and their production activities may be affected. I don't want any such thing to happen. So maximum of maximum, I am mentally prepared that if the remaining 9 units do not contribute anything, I will contribute and clean up the river, because I don't want my production to be actually getting affected. So we will consider what we have to meet as provision, and for others a contingent liability. So that is the first special situation under AS 29. The second special situation, and that is enactment of new legislation is virtually certain. Right, enactment of new legislation is virtually certain. By virtually certain, we mean 100% surety, right? We know it with 100% guarantee that so and so thing will happen in future. That's what we call as virtual certainty. Now, enactment of new legislation is virtually certain. Right now there is no law, but it is virtually certain. 100% surety is there that a new legislation will be enacted, and because of the new legislation, you may be found liable. So right now I don't have an obligation, or I do have an obligation but of a particular amount, and a new legislation is going to be enacted, and because of which either a new obligation will be created or the obligation that I have already recognized, its amount may change. What to do in this kind of a situation? Once you are 100% sure that a new legislation will be enacted and because of which you will be found liable, go ahead and recognize the provision. Or if you have already recognized the provision, then go ahead and update that particular amount. For example, we are having, let us say, something like a payment of bonus act. So I apply the payment of bonus act to my industrial unit, and accordingly I calculate the amount of bonus and I have provided for the same. But I also know at the same time that a new provision, or let us say a new section or some existing section of that particular bonus act is going to be amended, and because of which I may have to pay now more amount of bonus. See, most of the times what happens is, this is how the legislations are enacted. The government all of a sudden does not introduce a new legislation. Most of the times a draft will be prepared, and then it will make a lot of news also. So when I'm reading the newspapers, when I'm watching the news channels, I do have a fair idea that something is going to happen in the Payment of Bonus Act. And then the draft will be prepared. And once the draft will be prepared, it becomes even more certain. If there is something which is going to go in the favor of the workers, if something is going to go in favor of the employees, then it is more or less virtually certain that the parliament will definitely pass that particular law, or the assembly will pass that particular law. So I am in a position where I am able to judge from the very beginning that yes, this particular provision is going to be inserted or amended 100%. So when I read that revised section, I realize that the bonus that I have already provided, it will increase by another 20%. Now don't wait till that particular law is actually enacted. Since the enactment of the new legislation is virtually certain, you should update the amount of provision. If you have already made a provision of, let us say, 1 lakh rupees, and it is virtually certain that this will increase by 20%, please go ahead and recognize further provision of 20,000 rupees. So although it has not become an act right now, but it is virtually certain that it will become an act, please go ahead and recognize a provision for the same. So that's what we do if enactment of a legislation is virtually certain. Let's discuss a third special situation. This is with respect to reimbursement of expenditure incurred. Right, reimbursement of expenditure incurred. Many a times the contract is such that you are expecting a reimbursement of either the entire expenditure, if not entire, some portion of that particular expenditure. So maybe you have this kind of an agreement. first the expenditure has to be incurred by you, and then you have to claim a reimbursement of it from another party. For example, let us say you have taken some franchise of some particular company. So let us say there is some company ABC Limited. It has provided a franchise. So a franchise is provided, let us say, to XYZ. So XYZ has a franchise agreement with ABC. Now the franchise agreement itself suggests that XYZ has to first incur some advertisement expenditure. Okay. And then the franchise agreement itself provides that 80% of this expenditure will be ultimately reimbursed by ABC. So first, XYZ has to incur the expenditure. Once the expenditure has been incurred, you have to claim a reimbursement from reimbursement from ABC. So this is what is giving rise to a possibility of reimbursement of expenditure. What should I do in this kind of a situation? Think for a moment that the advertisement expenditure is of 1 lakh rupees. So XYZ will have to incur an expenditure of 1 lakh and then claim 80% of it, which is 80,000. So I am supposed to claim 80,000 rupees from ABC. Now what should I really do in my books? You know, there are two possibilities over here, and that's the reason we require guidance from AS29. What are the two possibilities? Possibility 1. I will debit my P&L by 1 lakh and I will credit my P&L by 80,000. See, 1 lakh is the expenditure that I have incurred, so naturally I will debit my P&L by 1 lakh. And 80,000 I am expecting to be reimbursed, so I will like to credit that to my P&L. Net effect is that 20,000 will remain debited to my P&L. Or, second possibility, why don't I just take 1 lakh and deduct 80,000 from it and debit my P&L by only 20,000? Don't you feel both the possibilities are there? Either I show the two items separately, or I set them off, and whatever is the net amount, that net amount will be disclosed in my P&L. What should I do? This is where guidance of AS29 is necessary. Now, what is the guidance of AS29? AS29 says that the primary responsibility of incurring the advertisement expenditure in the first place lies with XYZ. And that is the reason an expenditure of 1 lakh should definitely be debited to the P&L. AS29 argues that the nature of 1 lakh and 80,000 is different. And because the nature is different, the two cannot be netted. The two cannot be set off against each other. Not possible. So this 1 lakh will be separately debited to the profit and loss account. What to do with this 80,000? AS29 says that this 80,000 is more in the nature of a contingent asset. This is ultimately going to be reimbursed by, say in our example, it is going to be reimbursed by ABC. So it's more like a contingent asset. Contingent asset, a possible asset. Today you are incurring an expenditure of 1 lakh. After that you are supposed to lay claim to ABC. So you have to provide all the documentary proof that, see, this is the expenditure that I have incurred. So what I will do is, I will arrange a copy of the, let's say this advertisement was given in a newspaper. I'll arrange a copy of the newspaper. I'll have to arrange the invoice of my advertising agency where 1 lakh is getting disclosed. And all these documents have to be provided to ABC. ABC will verify the documents and come to the conclusion that yes, the advertisement has been incurred the way it was to be incurred as per the clauses of the franchise agreement. And after scrutinizing the entire thing, then ABC will release 80% of the expenditure that you have incurred. So this 80% of the expenditure that is going to be reimbursed is more in the nature of a contingent asset. As we have already discussed earlier, contingent assets cannot be incorporated in our books. It can be incorporated in our books only when it is 100% guaranteed that it is going to be received. So instead of a possible asset, it should become an actual asset, and then it can be disclosed in our books. So 1 lakh you have already incurred, so please go ahead and debit that to the P&L. Provide the necessary documentary proof now to ABC. Let us say before I finalize my books, or rather I will say before the year comes to an end, let us say, I get an email from ABC that everything is in order, we will soon release 80% of the expenditure. I just received this email. The moment I receive this email, the receipt of 80,000 is now guaranteed. Now I can go ahead and recognize that as an asset in my books. I hope you are getting it very clearly, right? I provide the documentary proof. I receive an email from ABC that we are in receipt of all the documents and everything is as per the the agreement that we had agreed upon. And yes, we are ready to reimburse 80% of the money. It will soon be released. They are not releasing it, but it will soon be released. We follow accrual principle of accounting, so we don't have to wait till it is actually released in cash. So the moment I receive this email, its receipt is confirmed. It is now no longer a contingent asset. It has now become an actual asset. And if it is an actual asset, I can show it in my books. But I will not show this as an income. I will show this as a recovery of an asset. So if I really address the final solution over here, 1 lakh will be debited to the P&L in any case. And once it is confirmed that 80,000 is receivable, I will credit my P&L by 80,000. But you will not credit the P&L by 80,000 as an income. Reimbursement of an expense is not an income. So you cannot show this as other income. Instead, you should be showing this as a realization of an asset. So I will credit my P&L not as an income, but as a realization of the asset. What if by the time I prepare my financial statements, I don't get any confirmation from ABC? I have provided all the documents, but ABC has not confirmed whether it will release 80% or not. If you don't get any confirmation, then it is not an actual asset, then it is a contingent asset. And we know very well under AS 29, what do we do with contingent asset? You are supposed to ignore it, right? So you will simply ignore this item. I cannot show it in my books anywhere. I cannot provide it, nor I can disclose it. So the two items that we have over here, their nature is very different. So no netting, no set-off is possible. Fourth special situation is with respect to an onerous contract. Right? We are referring this as an onerous contract. If some contract becomes onerous and all the three conditions for recognizing the provision are getting fulfilled, you should go ahead and recognize a provision for the entire tenure of the onerous contract. That is the requirement of AS 29. I'll again repeat. If you come to the conclusion that your contract has become onerous and all the three conditions which are there for recognizing the provision, if all those three conditions are getting fulfilled for an onerous contract, recognize a provision for the entire tenure of the onerous contract. Or rather I will say recognize the provision for the entire obligation that is possible for an onerous contract. But of course the very first thing that comes to our mind is what exactly is an onerous contract, isn't it? I'd like to know what do we mean by an onerous contract. Okay, what is an onerous contract? If you come to the conclusion that your committed cost of completing the contract exceeds our we can say probable revenue, or we can even use the word benefits, right? So your probable revenue or the probable benefits from the contract, I can consider this as an onerous contract. A contract becomes onerous when your committed costs are exceeding the benefit that you are going to derive from completion of the contract. When you come to this conclusion, we will consider this as an onerous contract. For example, you have entered into a contract, think in this way, you have entered into a contract for supply of some finished goods, right? Let us say some 10,000 units you are supposed to supply, and the selling price that has been decided is 100 rupees. So today I am signing a contract. In that contract I am supposed to supply some finished goods. The selling price has been fixed. One unit is going to be sold at rupees 100. And based on this, our contract is for supplying 10,000 units. Now, when can this contract become onerous? Let us say after we sign this particular contract, all of a sudden certain developments happened in that particular industry, and because of which abruptly the prices have increased. And because abruptly the prices have increased, maybe earlier your cost of production of this particular item was 80, but because the prices have increased, it has now become 120 rupees. So my cost of production has all of a sudden increased to 120. Now I have already signed a contract that I will supply the finished goods to you at 100 rupees per unit. At that time my calculation was that the cost of production is 80. So I felt that this is a very good contract. I'll be able to earn 20 rupees per unit multiplied by 10,000 units. That's a good sum of money that I was expecting. But because of abrupt changes which have happened, something has happened in an unplanned manner, and you realize that your cost of production is now 120, and you have committed to sell something that you will manufacture at 120 at just 100 rupees a unit. We scrutinize the entire contract. There is no possibility of increasing the selling price now. Let us say there is no escalation clause, nothing is there. So my contract is clear. I have to supply 10,000 units at 100 rupees. So although I know that my cost of production is higher, still I will have to sell it at 100. I can conclude that my contract has become onerous. That's what we put as a onerous contract definition. My committed cost, right? My committed cost of completing the contract is 120, right? If I look at over here, it's actually 120. But my expected benefit is only 100 rupees. So the contract has become onerous for me. AS 29 says that if the contract has become onerous, then find out what is the amount of loss that you may suffer, and that loss should be provided for. Of course, the main three conditions which are there, those three conditions should get fulfilled, and you should recognize a provision. So this is a good example of an onerous contract. Yes, in this contract, it is also possible that I may call up my client. I may tell the client that, see, sorry, I promised to sell you at 100 rupees, but all of a sudden there have been some developments, and because of which, in a very unplanned manner, because of which my cost of production is increasing. So instead of 100, now I want to sell to you at 140 rupees. Right? Earlier my margin was 20 rupees a unit, so now my cost of production will be 120. So I want to sell it at 140 rupees. But the client refuses. With whom you have entered into this contract, that client refuses, that I'm sorry, our contract was at 100 rupees, you have to supply the raw material to 100. You decide, let us say, to set aside the contract. You are like, no, I can't supply the units anymore. It's simply not possible. So I want to set aside the contract. If you want to set aside the contract may have a penalty clause, isn't it? So you have to look into the amount of the penalty. And then, in case if you have decided to set aside the contract, if you have decided that why should I suffer a loss of 20 rupees a unit, you may decide to set aside the contract. And if you are setting aside the contract, you may have to pay a penalty. Fine. The contract has become onerous. You'll have to go ahead and recognize a provision for the penalty. But a provision will be necessary. That's what we mean by an onerous contract. And finally, the last thing that I want to really discuss under AS 29, not necessarily a special situation, but we must understand under AS 29 prohibits discounting of provision. Right? We cannot discount a provision. It is not possible. No discounting is there except for one exception that we will discuss a bit later. But when it comes to the recognition of provision, discounting of provision is not possible. If you take that main illustration that we have discussed so many times even earlier also, right? So many times we have discussed that particular illustration. You are selling on warranty basis, let us say for 3 years. So I sell on warranty basis for 3 years. Tell me what will happen in year 1, 2, 3. Right? I am promising my customers, I am promising my client that see, you buy this product from me, it develops a manufacturing defect. In the next 3 years, bring it back to me. I will incur the repair expenses. I will make good the repair expenses. You don't have to do it, right? And then you can take back the repaired product. And in case of the manufacturing defects are severe, I don't even mind replacing that product. So this is the promise that you have given. Now what will happen? Since your warranty period is for 3 years, some products will be returned in first year, some product will be returned in the second year, some product will be returned in the third year. So what I do is I apply my judgment. On the basis of that, I find out what is the amount of repair expenses I'll have to incur. I am of the view that in the first year I may have to incur a lakh of rupees, second year perhaps 75,000, third year perhaps let us say 50,000. So this is the estimate that I am making. And my estimates are that this is the amount that I shall be providing for. Now, this will happen in first year, at the end of the first, at the end of the second, at the end of the third, while provision is to be recognized as on today. If I apply the principles of finance management over here, then 1 lakh that I am incurring at the end of the first year is not comparable to 75,000 incurred at the end of the second year, because they are at different timelines. So if I apply the principles of finance management, I should discount and find out what is its present value. And its present value should be provided for. See, provision will be recognized as on today, while this I will incur at the end of the first, second and third year. Provision will be recognized as on today. So what I should do is, ideally I should be discounting these amounts, bring it to its present value, which is as on today, and because it is as on today, I will recognize a provision for the same. So this is what I will do if I am allowed to carry out discounting of the provision. AS 29 is clear, you cannot do discounting of the provision. So I have to simply take a total of this and recognize the provision. I'm not interested in the total, right? What is the amount? I'm not interested in that. What I'm saying is whatever amounts you have projected, take a total of it and debit that to your P&L. Discounting of provision is disallowed by Accounting Standard 29. But having said that, there is one exception. You know what? One exception? The one exception that we have is because of Accounting Standard 10. Right, Accounting Standard 10, Property, Plant and Equipment, PPE. If you recall in Accounting Standard 10, when you are calculating the cost of PPE includes initial measurement of dismantling cost. For example, I buy PPE as on today, I am installing it. For installation, I am incurring certain expenses. This asset, let us say, will last for 10 years. After 10 years, I'll have to replace it. If something was required to be installed as on today, then after 10 years, when you will be selling that particular PPE, or even you are scrapping that particular PPE, it has to be dismantled. So from today itself, you have committed yourself to the dismantling liability. So what Accounting Standard 10 PPE says is, that the cost that you are going to incur after 10 years, you have already committed to it as on today. So that amount should be added to the cost of the PPE. But the words used in AS10 is, you have to make an initial estimate of it. What do we mean by initial estimate? I will first find out that after 10 years, how much I will have to incur. So, as a dismantling expenditure, right, as a dismantling expenditure, I am calculating it. Let us assume for simplicity, it is turning out to be 1 lakh. So I am of the view that I'll have to incur a lakh of rupees, but when? After 10 years when I dismantle it. But what Accounting Standard 10 says is, include the initial estimate. By initial estimate we mean, this 1 lakh that I'll incur after 10 years, I will discount it and find out its present value. And that present value I will add to the cost of the PPE. Now this dismantling liability will be covered by Accounting Standard 29. So you are recognizing a provision for dismantling liability, isn't it? So accounting of dismantling liability will be governed by AS 29. Dismantling liability is arising out of Accounting Standard 10. AS 10 says that you have to discount and find out the present value. AS 29 says that sorry, discounting of provision is not possible. So we are having two accounting standards which are at odd against each other. AS 10 says discount the dismantling liability and recognize it. AS 29 says sorry, discounting of provision is not possible. So what is the way out? The moment accounting standard 10 got revised, AS 29 has also got revised. AS 29 now says that provisions cannot be discounted except, right, an exception has been introduced. Provisions cannot be discounted except dismantling liability recognized in terms of accounting standard 10. So this is an exception which has been now provided in AS 10. But apart from this particular exception, no other provision can be discounted.